Welcome to the Clear to Close podcast with your host, local mortgage expert Ryan Bolton. Ryan has the questions and answers, tips and tricks, do's and don'ts, and expert guests to explain all the steps needed to buy or sell real estate. And now it's time for the Clear to Close podcast.
Hey everyone, my name is Ryan Bolton with Patriot Home Mortgage. I'm here in southern Utah. I loan in the states of Utah and Nevada. You can check out the video of this. If you're on podcast, you'll see it on the different podcasts, but there's also a video of this on my YouTube channel. If you go to Mortgage Nerd, and nerd is spelled with the 3 instead of an E for the nerd part. So it's Mortgage N3RD. It obviously makes more sense when you write it or when you see it on just a little thing here. You know, you can see it a couple different places, but it was just kind of a fun play on words, gamification, and Mortgage Nerd was already taken. So I thought it'd be just kind of fun to have Mortgage Nerd with the number 3 built into there. So today I've got a fun little topic I wanted to talk about. There's different types of mortgages that are out there. There's FHA and government and all these kinds of loans, but there's kind of 2 different main classifications. So today that's what I want to kind of break down is the market share of these different loan programs and how they work. One of the big topics I want to hit on is what's called a non-QM. Now, this is kind of a fancy word in a sense because it stands for qualified mortgage. Back in 2008, there was this buzzword. If anybody's been in the industry or owned a home in the last 20 years, you're going to know this term called subprime. It led to the housing crisis of 2008, and a lot of it was just loose lending standards because they didn't really have what was a mortgage. It could be anything. It was just a loan against a property. So they started saying, okay, we want to have a classification of qualified mortgages that fit within a certain guideline. So they called them QMs or qualified mortgages. So what doesn't fit in qualified mortgages became a whole new segment of the industry called non-QM. How clever, huh? You know, we can get pretty clever in the mortgage industry, but the subprime got away, the backlash with it. I mean, there was a lot of good products within subprime loans, but the news was bad about it. The cycle was bad about it. It got just such a negative branding with it. They had to kind of throw it all out and start over with something, but they also had to put more safeguards in there. They had to put a few things in there to make sure that the 2008 crisis didn't happen. So a lot of regulation changed. A lot of things happened in the industry in 2008 that we still deal with even to now, even until 2024. So it is something where I want to break down some of those different loan programs. So we got slide number 1 real quick is today's topic and today's theme, which is right there. There's on, yes, here's the differences between, I think we might have them in a different order. There we go. So today's topic is non-traditional mortgage options. We're going to talk about non-QM. So let's go to slide number 2. Number 2 talks about the 2 differences. A qualified mortgage is a mortgage that sets up certain guidelines, certain minimum standards set up by the CFPB, the Consumer Finance Protection Bureau. This was one of the bureaus that was created after 2008 to consolidate a few of these other industries under one bureau. I mean, that's what government likes to do, right? If something goes wrong, we got to create a bureau that manages it. Well, that's where the CFPB came about. And they're supposed to also guard on payday loans. They do credit cards. They do other types of loans, not just mortgages. But a lot of things were kind of pulled under the umbrella of the CFPB to regulate the Dodd-Frank bill and just some other aspects within mortgage lending. So they set up some minimum standards that if you follow these minimum standards set by the CFPB, which is all of Fannie Mae, Freddie Mac, government-backed loans, become what's known as a qualified mortgage. What also happens to the lenders, if they follow these guidelines, is they have what's called safe harbor. So this means that a borrower or a lender or an investor can't sue them because they didn't show the ability to pay back that loan. So it gave them some protections that if you follow these guidelines, then you'll have safe harbor against any legislation. You'll also be helped out with potential bailout money. There were some provisions in there that if they follow these laws and something happened and their bank went bust, that there would be some backing of money, where if they didn't, they're a little more on their own. They're taking on more of the risk. They won't have any bailout money if that ever arises again, if there's any kind of housing crisis again. So they really said, okay, here's the loan that qualifies for qualified mortgages. Well, there's some loans that just don't fit those guidelines. Doesn't mean it's a bad borrower. Doesn't mean it's somebody that has no credit. Doesn't mean that they shouldn't get a mortgage when there's lenders that want a loan and take on that additional risk. So this new industry kind of was created out of the ashes of subprime loans called non-QM, non-qualified mortgages. So these are things that are even like jumbo loans. Loans that are over a certain loan amount don't get financed by Fannie or Freddie. they end up going into the jumbo market, which is technically a non-qualified mortgage. Or you'll have somebody that's self-employed, that maybe they have lots of cash flow coming through their business, but they have a lot of write-offs as well. And the guidelines with Fannie and Freddie say you can't use that income, or they don't use all of it, or you can't qualify debt ratio-wise, even though you have plenty of cash flow. Or it's something where you have a lot of money down, but no other income sources that are verifiable, or foreign income. I mean, there's all kinds of ways people make money. So lenders have come up with saying, okay, in that scenario, we're comfortable taking on the risk if the credit scores are higher, or the down payment's more, or the property location, or something to help offset that risk, even if Fannie, Freddie, FHA, VA won't do those loans. So I want to talk to you today about the most common 5 non-QM loans. There's a lot of them out there, so there's no way to get to all the different nuances of these types of loans, but I think a lot of them fall under these 5 different categories. So let's go to that. Slide number 3. And again, you can see these slides if you go to the YouTube channel. If you're on the podcast, you can jump on there as well. So hopefully that makes sense. This next slide breaks down the market share of each of these major loan programs. So you can see that a big percentage, 53%, take, or over 50%, are Fannie and Freddie. They're conventional, prime, conventional loan programs. That's Home Ready, Home Possible. A lot of these programs have these names. In fact, most loans, whether they're a Fannie or Freddie loan, run through their automated system to even give kind of a preliminary approval. So they've actually come up with a system where almost every loan, whether it goes to Fannie or Freddie, runs through their system to give it an initial approval based on what's on the application. So they're obviously the dominant force when it comes to mortgage lending in the United States. But then you start getting into these other segments. FHA and VA loans take up a certain percentage, and then there's a whole swath, about 20%, that aren't in these other categories, that are private money loans, that are portfolio loans. Maybe second mortgages kind of fall into that category. And of course, you've got these loans that don't quite fit Fannie and Freddie guidelines, but still make sense to do, that still have enough risk management to where it makes sense to say yes to that particular client. So it's a big market share, more than people realize that these loans even exist. I can't tell you how many times I talk with people that are self-employed and think they have to have 2-year tax returns, and they think they got to wait a couple of years to get their returns up, when there is options for people to get financing without having to use a tax return. So today we're going to talk about the 5 most common non-QM loans that don't fit those guidelines. So let's check slide number 4, I believe. Here we go. The 5 non-QM loans we're going to talk about. Let's go to slide number 6 now. Number 1. This is called a DSCR, which stands for Debt Service Coverage Ratio. It's a fancy name to basically say that the rents on the property, so it's an investment property that's receiving rental income, is enough to cover the mortgage payment. So it kind of makes sense. So if you're sitting there going, okay, I have a mortgage payment of $1,500, but the rents are $2,000, it covers the debt. So I don't need any other income. That's really what this loan is trying to do. It's basically simplifying the tax returns and all the other ways to get financing that are more the traditional route by saying, hey, if the property covers the debt, then we can move ahead with doing the loan. Now, is it 100% financing? Of course not. It's not going to be anything that has mortgage insurance. It's going to require more money down. I have started seeing some of these programs go with as little as 10% down, which is a big increase, but it does take credit scores and source of the funds, and they do want to see a higher ratio than just 1-to-1. So say the mortgage payment's $2,000, rent's $2,000. They want to see a little more of a buffer than that. They like to see 1.5, even 2 times the rent versus the mortgage payment. So it's a great option. I've seen people that have money that maybe they're cashing out an investment property, want to buy another one or upgrade from a single family to a duplex or a fourplex. So they have 1031 money or other ways to get the down payment to simplify the interest rates and simplify the documentation that's needed by simply going with these types of loans. So it's a buzzword in the industry. A lot of lenders now offer this program that's just, again, DSCR, which essentially means that the rents can cover the mortgage payment. It's a great loan option. Let's go to slide number, I'm losing track of the numbers now. I'll just say next slide. So number 2 is bank statement loans. These have been around for a long time, even during the subprime days, and it really is probably the next best interest rate. It's the next best program to still provide some sort of income without having to do a full tax return. What they do is they'll take a certain number of months of the business or personal or both bank statements, add up the deposits in those statements, and use that as your income instead of the tax returns. So this is great when you have businesses that have just a ton of cash flow, but they also have some expenses that go out. So we can just see if that there's enough money kind of going through the account to debt service the new loan. Now, I would say the average is 12 months. I've seen times where they'll go down to 3 months, 6 months, that kind of thing. But if you have 12, usually the rates and terms are better because you're providing a larger snapshot of how the money's been flowing through your business. The trick is whether you have a true business account or a personal account, you're acting as a business. So here's a tip for anybody that's self-employed. Really make sure you're separating out business from personal. And if the income overlaps or switches, you can run into issues with the LLC, or if you ever get sued, they can come after your personal stuff because there's that commingling of those funds. So as a tip for you, if you're self-employed, you really do want to separate those out. That doesn't mean you can't pay yourself a wage or transfer money from the business to the personal. You just really want to document it. I don't think there's a bank out there that doesn't allow you to put a little memo in the transfer that says what that transfer is for. And you just want to make sure it's an income draw or it's some sort of label to it to just insulate yourself of any issues you might have. But the more you can separate business and personal, the better you're going to be. But for a mortgage loan on this type of program, they're going to take the deposits over the 12 months, divide it by 12, and then they'll usually take some sort of expense ratio. Usually it's 75% of the total deposits is what they're going to use towards your debts, which then they'll have a debt ratio of anywhere between 45 to 50% of that. So there's still a little bit of a formula that gets down to what we can use as income, but this can be a lot easier than providing tax returns, especially if you had a lot of expenses or a one-time expense, or anybody that's self-employed, they're trying to get that bottom line as low as possible. So they pay as little to Uncle Sam as what's allowed. So a lot of times that hurts you for the loan. So these programs have kind of come up with a way to say, okay, we know they're making enough money, they're cash flowing, they're getting enough receipts in. This is another way to at least say, okay, we'll take on a little additional risk by not having the tax return, but we'll still show that there is income coming into the business. And every lender is going to be a little different. That's part of my job, is knowing, okay, when I'm sitting down with a client, how's their income look? Where's it flowing through? Is it personal? Is it business? Is it both? What's the best way to get it? And it is the full, complete bank statement. Some people just don't want to have a full, complete bank statement in a mortgage file, so they don't want to disclose that. Or I've also seen times where there's lots of NSFs or lates or stuff like that, so that gets a little tricky when you're trying to use bank statements. But it can save you on having to do the tax returns. It can save you if you haven't filed, or if it's something where you just write off so much that you can't actually qualify for a mortgage loan. Again, is this 100% financing? No. It's not going to be 100%. It's not going to have mortgage insurance tied to it. You're going to have a larger down payment, but it's not a no. So many of these programs, if you didn't fit Fannie, Freddie, FHA, you were just a no. These programs are trying to fill that gap and say, okay, there's some way to make this work where you actually can get a loan if you've got the score and the down payment, and you do at least have that cash flow going through the business. So I think that's a really good program for the people that actually need it. Okay, let's go to the next slide. So that was 1 was DSCR, 2 was bank statements. Number 3 is the jumbo loans. So jumbo loan limits are with Fannie and Freddie. They've moved up to $766,000 and some change. In high cost areas, they can go even higher. FHA is down in that $480,000. I think it's $490 is what it's moved up to. But it also is certain areas they can do more. And if you have multiple units, if it's a duplex, they allow more, fourplex. So if it's a bigger number of units, they will allow those loan limits to go up. But once you reach that loan limit for that county or that property type, anything above falls under the jumbo loan category. Now, we've seen a big shift in jumbo loans. They're not backed by Fannie and Freddie. They're not securitized the same way. A lot of times they're more portfolio. A couple of big lenders that were out there doing jumbo loans have started kind of pulling back their offering and their products. So there has been a little bit of a gap or a little bit of a need for the jumbo markets really has softened. And this is anything in that kind of 750, 775 or above. But there's areas where the jumbo limit goes clear up to 1.2 million for up to that jumbo limit in high cost areas. But technically that's a non-QM. That's not a qualified mortgage under the guidelines. So it is something that falls under that category. Let's go to slide number 4. This is the 4 non-QM products that are out there. This one is one step down from bank statements, kind of a step down from any kind of DSCR rental income. This is where you just have a 1099. It doesn't have the expenses out of it. You just have a 1099 for a dollar amount, and they use that number as part of your income. Now, a scary thing for a lender, we know, okay, the 1099 is $100,000, but we know you have expenses with that, whether it's car car expenses or insurances or material costs or things you had to buy as part of that. So they know you're not netting that amount, but they're still going off that gross amount off the 1099. Another step down from that is just the profit and loss statement that just says, okay, last year I made X amount. I had this many expenses. Down at the bottom, that's my bottom number. Doesn't have to be provided by CPA in most cases. It's just something you can provide that says, yep, this is how much money went in and out of my account, as if you were preparing to do the tax returns, but it's not audited. It's not something that even goes into like the CPA or the IRS or anything like that. So again, it's a little bit of just, at least there's something in the file that says what they said they made. So we have some sort of recourse that we didn't do any kind of predatory lending to somebody by doing a loan and not showing how they made the payment. So at least we have some sort of documentation in the file that says they said they made $100,000. We don't check it any further than that. So you say, well, why would a lender do that? Well, let's say you got a client that's putting 50% down, has a 900 credit score, has been in business 10 years. We're going to say no? No, we want to say yes. We want to find ways to say yes. So we have certain programs that give us at least the chance to say yes. Is the rate going to be lower than the conventional loan? No, of course not, because it is higher risk. There's less investors that want that type of risk, but it's still out there. There are programs out there that can help people get into homes, allow them to upgrade, do these types of things. That's the fun thing in the industry. Yes, it's great to do conventional loans, all that kind of stuff, which we do a lot of, but it's also fun when a client comes in the door and says, I don't think I can get a loan. And you're saying, well, what about this? What if we provide this? And here's your rates and terms. Is that something that makes sense? Sometimes it does, sometimes it doesn't. But at least it's an option. That's what makes the industry fun, is problem solving when somebody wants to own a home. Let's go back to that slide again. There's one other part of that slide is the asset depletion. So you've got the 1099s, you got the profit and loss, or you have money in the bank. So let's say you're doing a $300,000 loan, but you've got $300,000 in stocks, savings, bonds, some retirement, something like that. Well, they can say, okay, well, they obviously have enough to cover the loan, so we'll take a certain percentage of the money they have in the bank, use that as income, and then they only have to qualify for whatever's left over. So it's a way to be able to combine their self-employed, their 1099, their asset depletion, all into a couple different loans to just make the risk offset enough to at least be able to say yes to that client. So asset depletion is starting to kind of kick up as another way to combine some of these loan programs to just do make sense loans. Are they more risky? Yes, but is it worth the risk in some cases? Sure, especially if it's good loan to value, good credit score, time on the job, other compensating factors that can overlook that maybe they just don't file the returns or write too much off or just don't qualify on paper with what's actually on their tax return. And I've even had some people that have like 10 businesses and they just don't want to get every single tax return. They're like, you know what, I'll pay a little more in the interest rate to avoid some of the paperwork of a mortgage loan. That's where some of this stuff can kick in. Again, it's not going to be the lower rates. It's not. But it's still going to get them into a home. It's still going to have the ability to have the appreciation. It's still going to give them a chance to upgrade. And I've had a lot of people say, well, I'd rather pay a little more in interest rate and less to Uncle Sam. So that even kicks in a little bit, or just less paperwork and just allow this to happen, especially if it's a long-term purchase or they know they're going to be able to pay it off with the sale of another property. I mean, people buy and have all different ways of trying to make all this work. Now let's go to number 5. This is the last slide here, I believe. This is flat out stated income. This you don't even put, either you put a number on the application or there's the no ratio, which is also on the slide there you see. It is no ratio. They don't even put anything in the box. They just leave it completely blank. There's no calculation for debt ratio whatsoever. This is probably the most aggressive and the most need for compensating factors to even do this type of loan, but it's starting to come back. So I know some people think, well, stated income, oh no, we're heading back into all this kind of stuff. But I tell you, it's not 100% financing. It's not with a 500 credit score. I mean, this takes the most compensating factors to even look at this type of loan program. That's what happened in 2008. They got these types of programs for anybody. You know, for you fog a mirror, you got the home loan is what they used to say, when now there still is other things you have to do. You have to prove the down payment. It's not 100% financing. It's not an ARM. It's not a negative amortization loan. So it's still safer in other ways, but it has to still make sense. But I still ask the clients that get upset when they hear, okay, oh, stated income loans are all bad. I'm like, well, wait a minute. If the guy's got 30% down on a $500,000 home, been on the job, has a good credit score, like a great credit score to get the better rates, why would we just say no because there's no income to verify? If we can see he's making his payments, he hasn't missed any payments on his credit report in 10 years, and he's obviously making money, and there's other things we can see that the guy's worth the risk and puts the money down, it's a make sense deal. it's a deal you shouldn't just say no face value and just say, okay, just because that one category, even though all the other categories are good. Now, if they start getting too aggressive and all of a sudden start offering the stated loans more and more and more and more, that's when you start hearing the bells. I remember back when I was doing other radio shows on KDXU and some of the other stations here locally, I kept warning, saying, boy, these subprime loans are getting way too aggressive. In fact, I remember one time I had a whole loan package ready to go to a lender. Had the tax returns, had all this stuff, and I was getting ready to submit it. And I remember the rep for the company said, why are you submitting all this paperwork? Just go stated. And I'm like, well, no, but I've got it all right here. I mean, this is part of getting the better rates. He's like, no, just simplify it. Just go stated. And actually state more income than what you actually have here. And I'm like, well, it's such a weird time because those were the loans everybody was kind of going after. Wall Street was going after, and they were trying to simplify and just shove as many loans into the system. Wall Street just loved the way they were securitized, and the risk seemed to be zero, that homes would always go up. Nobody would ever miss their payment. Defaults were really low. So that's when you start worrying about a housing crash when it comes to another real estate crash, when it comes to at least the mortgage side, is if these certain programs start to get more aggressive. But to completely throw out the program with the baby with the bathwater, as they say, that's where I think they went too far in 2008, 2009, even through 2015. There wasn't these programs starting to come back. So there still makes sense. There is still times where if they're putting enough money down, they've got the credit score, it makes sense. It's worth the risk. Because even if you did say 100 of those loans, there's still going to be some that are going to foreclose, whether they're stated income or not. Because there's going to be times where they lose their job, their health goes down, or something happens to where they go into foreclosure. It's a natural part of mortgage lending. And we found over the last few years that the default rate is crazy, crazy low, almost to a point where it's not healthy. It's not adding that inventory back on, or we're saying no too much by not allowing more people into buying homes. So I think that this non-QM, anything in capitalistic societies are trying to fill a need in the market. And that's really what non-QM is trying to do, is trying to say, okay, where are we saying no? What loans could we have done if the guideline was different? Like, what's the most common guideline that we're saying no to clients on? Credit scores are always going to be a hard and fast one. I don't think you're going to see anything get crazy different with credit scores. But income is a big one because people make their income a lot of different ways. They disclose it different ways. They bury money when it comes to expenses or what they can write off and all those types of things. And obviously do what you need to do with your tax returns. You still want to get those filed. Just because you have this loan program doesn't mean you can't file your tax return. But this time of year, I do a ton of reviews for people that are self-employed. And what I always tell them to do is get your taxes ready as if you weren't doing a loan, just your normal tax return. Then we'll take the numbers on that return and show you how much you qualify for. Then if that's not enough, you can go back to the CPA and say, okay, if I don't claim all the expenses, if I don't try to write as much off to get that bottom line up a little bit, how much more do I owe to Uncle Sam? It's worth at least running the calculation. Just yesterday, I had a call with a client that says, how much do I need to claim to do a $500,000 purchase? Well, it depends on your other bills. It depends on what deductions you have. It depends on those. If I tell a client just to hit a number, we're going to be leaving money on the table. We're going to be paying more in taxes than what you really need to pay. So I always say, let's start with a draft, get it 80% of the way there. Then we can tweak it a little bit to see if it's worth paying more to Uncle Sam to get the better rates. Or we start looking at these non-subprime or these non-QM loans and say, okay, is this a better alternative than having to just claim a whole bunch more income or less expenses to still qualify? Most of the loans with Fannie and Freddie, FHA, VA, they want a 2-year history. They want 2 years of tax returns. So if 2022 is already filed and you claimed a loss or very little income, now you have to claim even more in 2023 to offset that. So that, again, these non-QM loans kind of help bridge that gap a little bit because you're going to pay it in taxes or interest. They're going to get it one way or the other. So what's the better option? What minimizes that the most is part of our job. Now, I'm not a CPA. I can't give you legal advice on what to do, but I can at least take a look at the numbers and say, based on this return, you qualify for XYZ. So if you want to do more, you've got to go back to your CPA and adjust the numbers. If it's too much of an adjustment, let's look at these other programs. Let's look at bank statements. Let's look at stated income or no ratio. Let's look at these other ways to help get you financing if you fill the other boxes, if you kind of check the other boxes, and the only thing we're really missing with is the taxes. If you're getting ready to buy a house this year, have someone like a loan officer. I would help you with that as well. Obviously, here in Utah, Nevada is where I land. Review them before they're filed. It's so much easier to make tweaks than it is to go and amend the whole return. If you're thinking about buying a house this year or even next year, get working on how your tax returns look now. That way you can also even out how much you have to claim. Maybe you do need to take a little more of a hit in 2023, but you'll be ready in 2024, 2025. So I hope this was helpful. Love to talk to you about how this works for self-employed borrowers. Go to my website at ryanbolton.com, and we'll see you next time on the Clear to Close podcast.
This has been the Clear to Close podcast. Please submit your comments, questions, and topics for future episodes to cleartoclosepod@gmail.com. That's clear the number 2, closepod@gmail.com or ryanbolton.com. Please like, follow, and share. And until next time, this is the Clear to Close podcast. The views expressed in this podcast do not necessarily reflect those of Patriot Home Mortgage, Equal Housing Lender, NMLS number 299717. This has been a production from a podcast studio.